Next one, we have bullish engulfing pattern. Bullish engulfing pattern, we see them very often. Bullish engulfing pattern are found in a downtrend. So if you have been having a downtrend and you see this formation, when the green candle is bigger than the red candle in a downtrend, it means there's about to be an uptrend. It means the activities of the buyers in this green candle is more than the activities of the sellers in this red candle. That means in the market, we have more buyers than sellers, and when there's more buyers than sellers in the market, the price is going to go up. So these are the properties. It happens when the bullish candle fully covers the bearish candle in a downtrend. Remember, you want to be looking for bullish engulfing pattern in a downtrend. It is always very valid at support zone. So when you see them in between charts, please, they don't mean anything. They only mean something at support. So when you see it as support, it represents a change in trend, a change to a bullish trend. So let's see this in a real life scenario. As you can see, we have been having a downtrend. So from this swing high to this swing low, we have been having a downtrend. After the downtrend at support, you can see that there was a red candle, and after the red candle, there's this green candle. You can see that the body of this green candle is bigger than the body of this red candle, which is a bullish engulfing pattern. You can see it. The green candle is bigger than the red candle, and this is what we discussed here. And when you see it as support, it means the price is about to go up. You can see the price went up. Do you understand? So that's basically what bullish engulfing does. The next one is bearish engulfing pattern. This is a direct opposite of bullish engulfing pattern. When the red candle is bigger than the green candle, remember we are talking about the body, not just the wicks. The wick does not matter. The body matters a lot. The red candle body is bigger than the green candle body. So for a bearish engulfing pattern, you want to be looking for them in an uptrend. They are found in an uptrend. So it happens when the bearish candle, which is the red candle, fully covers the bullish candle, that means the green candle, in an uptrend. So you want to be looking for a bearish engulfing pattern in an uptrend. When something is a bearish reversal pattern, you want to be looking at it in an uptrend. And when something is a bullish reversal pattern, you want to be looking for it in a downtrend. It is always very valid at resistance. Remember, resistance is the supply zone. The sellers are always more than the buyers at resistance. So price most likely is going to drop at that point or at that level. Let's look at this bearish engulfing pattern in a real life scenario. We already have a downtrend here. After this downtrend, then we saw an uptrend. From year to year is an uptrend. After that uptrend, we can see a bearish engulfing pattern. As you can see, the red candle is bigger than the green candle. It means the activities of the sellers is more than the activities of the buyers. Most likely the price will go down at that point because supply is more than demand. When supply is more than demand, price drops. That's why you saw that the price dropped from year to year. Do you understand? So that's a real life scenario in the market. So back to our slide. So the next one is dark cloud pattern. Dark cloud pattern is a little bit similar to a bearish engulfing pattern. The only difference is that the red candle here covers just 50% of the green candle. So when you see this kind of pattern in an uptrend where the red candle covers more than 50% of the green candle, it means that the trend is also about to change. So the properties are, it is a bearish reversal pattern. It means when you see it in an uptrend, the trend is about to change to a downtrend. It is formed in an uptrend. That means you see them in an uptrend. The body of the bearish candle must cover at least, you can see, it must cover at least half, which is 50% of the bullish candle, which is the green candle. So let's look at it in a real life scenario. This is a dark cloud cover pattern. You can see the red candle did not completely cover the green candle, but it covered more than 50% of the green candle. So when you saw it, what happened to the price? The price came down for a short period of time before going up. So when you see it, you start looking for a sell in the market. You start looking for a short in the market. When you look for a short in the market, it means if the price drops, you make money. So the next one we are going to be checking is the piercing pattern. And the piercing pattern is quite similar to the bullish engulfing pattern. The only difference is that the green candle doesn't fully cover the red candle. It only covers 50% of the red candle. You can see it covers more than half of the red candle. And this kind of pattern is formed in a downtrend. And when you see it in a downtrend, it represents a bullish reversal pattern. If we have been having a downtrend and you see a piercing pattern, it means the trend is about to change to a bullish trend. Do you understand? Let's look at it in a real life scenario. This is an example of a piercing pattern. These two candles, you can see the red candle, but the green candle has covered more than 50% of the red candle, which represents a bullish reversal. When you see it, it means the trend is about to change to an uptrend. So remember, the reversal candlestick pattern are only active at support and resistance, or you can say the supply and demand zone. When you see them in the middle of a chart, it doesn't mean anything. You can see them anywhere in between charts, in between trends, but they are only active when you see them at support or at resistance. And here we are seeing it at support. And when we saw it at support, what happened to the price? The price spiked up. So this is another example. This is a piercing pattern. You can see that the green candle covered more than 50% of the red candle, which represents a reversal at support. Do you understand? So after you see this piercing pattern, what happened to the price? The price spiked up. So that's what they do in the market. Please note that they don't mean anything in the middle of the chart. They only represent reversal at either demand zone or supply zone. Demand zone is support, while supply zone is resistance. So the next one we are going to be talking about is money star. And money star is a 3 candlestick reversal pattern. So this one is not 2 candlesticks, it's 3 candlesticks you must be looking for in the market. So this one must have a red candle, huge red candle. So the second candle can either be a doji or a spinning top. It must be a small candle. It doesn't matter if it has a wick or not, but it must be a small candle. And then the third candle must be a green candle. So that is a money star formation, 3 candlesticks formation. But remember, the third candle must be bigger than 50% of the red candle. So this candle must be more than 50% of the first candle. Do you understand? So when you see a money star, you must see a big red candle, a small candle. It could be a doji and it could be a spinning top, and it can be of any color. The next one must be a green strong candle too. It can be the same size with this candle, but it must not be less than 50%. It must be more than 50% of the red candle. So it is a bullish reversal pattern. When you see it in a downtrend, it means the price is about to go up. Do you understand? So let's see it in a real life scenario. This is a typical money star. So here, this 3 candlestick formation is a money star. Remember, we are saying this at support. This is a support zone. Do you understand? We are saying it as support. This is why these 3 candlesticks are active at this region. So let's analyze it. This is a red candlestick, a very long red candlestick. And then let me take this out. So this is a long red candlestick, and then the next one is a small candle. I told you, regardless of the color, it doesn't matter if it's green candle or red candle. So this is like almost a doji, but it's not really a doji, but it's just a small candle. And then we have the green candle, the long green candle. It's not as long as the red candle, but it's more than 50% of the red candle. We saw it as support, and then what happened to the price? The price went up. That's a typical money star for you. So the next one is evening star, which is the direct opposite of a money star. So for evening star, you want to be looking for it in an uptrend. First candle must be a green candle. The second candle must be a small candle. It could be a doji and it could be a spinning top too. But the third candle must be a red candle. And the red candle must be more than 50% of the green candle. Let's also look at that in a real life scenario. So this is it. This is an example. After an uptrend from here to this region, this is an uptrend from this swing low to this swing high. Then we have this green candle. Next to it, we have a small candle. It could be red, it could be green. It doesn't matter the color. Then next to it is this red candle. But in this one, you can say the red candle is more than the body of the green candle. I told you previously, for it to be an evening star, it can be longer than it, or it must be more than 50% of the green candle. So that's what evening star looks like. 3 candlestick pattern, the green, the small candle, and the red candle, which must be more than 50% of the green candle. So when you see this, there's about to be a downtrend. So in this place, you most likely be taking a short position. A short position means you're selling, and when you're selling while margin trading, it means you're going to make money when the price drops. Do you understand? The next one on the list is a tweezer top. So what is a tweezer top? A tweezer top is a candlestick combination where the eyes of both candles are at the same spot. It happens when the eyes of 2 candles occur at almost exactly the same level. You can say it could be any candlesticks. So far you see that the eyes of both candles are at the same point or are at the same level, it means that is a tweezer top. You want to be looking for this in an uptrend. You want to be looking for them at resistance. So at resistance, when you see 2 candles with the same eyes, that means that's a tweezer top, and there's going to be a reversal in trend very soon. Do you understand? Sometimes both candles could be of small size and it could be of any size. Please remember that it could be of any size. That's why I put 2 examples here. You can see that this is a red candle and a green candle. So it could be of any size. This is a big one and this is a small candle with long wicks. But you can see that the eyes are at the same level. So when you see them in an uptrend, they represent a bearish signal, which means the trend is about to change to a downtrend. The opposite of a tweezer top is a tweezer bottom. This happens when the lows of 2 candlesticks occur at almost the same level. You can see the lows is just direct opposite of tweezer top. When the lows of 2 candles are at the same point, it could be any size. The candles could be any size. That's why I use 2 big candles and 2 small candles as an example. Let's look for this in a real life scenario. It is difficult to see tweezer bottom and tweezer top, and that's why I won't be showing you in a real life scenario, but this is what they look like. So you must see tweezer top and tweezer bottom at both resistance or support. Do you understand? For tweezer top, you want to see it at resistance. Do you understand? In an uptrend. But for tweezer bottom, you want to see it in a downtrend at support. Do you understand? So that's all for candlesticks. So in the next lesson, I'm going to be showing you real life scenarios of candlesticks pattern. We're going to be picking it. It's just a little exercise for you to be familiar with them. So in the next lesson, we are going to be looking at that. Thanks for watching. I'll see you in the next video.